and Zurich session. We are going to start on time. Zurich, our two distinguished subject matter experts are from Zurich, which is a company headquartered in Switzerland. So Swiss time will apply in terms of starting on time. A couple of housekeeping and logistic information I would like to share with all of you. Please remain on the mute during the session, and please do not hesitate to use the chat box to ask questions or raise comments. I will convey to our experts during the session, and we're going to have time for a Q&A at the end of it. This is one of the many webinars organized by Parima with the support of our partners. Parima being, for the people who are new to it, as this is an open session, we are the Association of Risk and Insurance Managers across Asia Pac, which is about now 2,500 members across the region. I'm the chairman of Parima, but my day-to-day job is about being the head of risk and insurance for a company called International SOS, with headquartered in Singapore. For the time being, because of the COVID-19 situation, I'm based in France because of the lockdown there, where my family is based. So it's actually 10 a.m. for me. Before briefly introducing our two experts, we are going to give you a full extent of their resume before we go for the session. I just wanted to give you a couple of comments when it comes to Parima and COVID-19. This is, as we saw during all the sessions, digital sessions we did over the last 2 months, critical moment for risk managers, a critical moment for corporates. As we are now going into it is now time to look at how we are going to manage the return to operations, the return to work, and more importantly for corporations being represented during this call, the economic environment is going to be even the next years, and see how our organization will cope with it and adapt to this new environment. So we had a similar session a few weeks back in terms of the economic environment based on this economic outlook during this COVID-19 situation. And I'm very happy to have with us today two very good experts on this field. So namely Guy Miller, who is the Chief Market Strategist and Head of Macroeconomics at Zurich. And Guy is going to talk to us in a minute or so from Switzerland, and Hokan Hedström, with the Head of Asian Market Strategy for Zurich as well. I'm gonna give the mic to you, Guy, so that we can start the session. And I will convey the questions and comments to the two experts. So don't hesitate to use the chat. Over to you, Guy.
Good afternoon, everybody. Thank you, Frank. Just to pick up on your point about returning to the office, this isn't actually a picture behind you. This is the office. It's very quiet. We're slowly returning here at Zurich, but it's on a very slow, progressive approach to this. So what we thought we would do today is I'll kick off giving you the kind of the global view of how we see the world economy shaping up. Hokan will go into detail across Asia, and then I'll round up with a comment about the markets before we conclude and hand back to Frank for Q&A. Please do feel free to ask as many questions as you'd like to interject. Very interested to hear what you're seeing on the ground and to challenge our views as well. So maybe, Shaylee, if we turn to the opening slide from the presentation, just before we go into what we are now thinking, it's worth setting the scene, because when we were putting together our 2020 outlook back in December, we entitled it Fasten Seatbelts. And of course, back then we were expecting global growth to be slowing in terms of the growth rate. We were expecting a mild recession, and we were expecting, for example, equity markets to fall in the region of 20%. What we weren't expecting, of course, was not only the COVID-19 virus, so one exogenous shock, but also the collapse in oil prices. So a double whammy almost of two exogenous shocks that hit what was already a vulnerable global economy. And by that I mean that there was, in our opinion, there was an over-dependency on central bank policy. Indebtedness was at record levels at the corporate level, but also at the government level. And really, this was not a good environment for the global economy to weather any kind of unexpected growth distraction. And indeed, that's exactly what we've seen in the first quarter. But from here, what are we expecting? So maybe if you turn to the slide with the bullet points on that. What we've been seeing is that the lockdowns that we had been experiencing in most parts of the world, we felt were going to be about 2 months before the economies started to reopen. We also felt that over the course of Q2, Q3, we would see some form of virus containment, not an eradication. We didn't expect any kind of vaccination, but we would find a way of living with this to allow these economies to open up. What must be remembered, of course, is that the recession come depression that we're experiencing, this is by design. This was a function of trying to prevent the spread of the virus, and therefore it's almost a man-made recession that we're currently experiencing. And I think that's worth bearing in mind. Because importantly, we're now seeing in the terms of the stimulus that's being applied, the intention was always to keep the productive capacity intact in the economy that allowed these economies and allowed these businesses to gradually open up indeed when things were looking a little bit better. One thing that we emphasize, however, that the outcome is somewhat binary. The view that I've expressed here is one that we still think is the most likely outcome over the course of this year. But of course, what happens with the virus is going to be critical. And indeed, given the very low levels of economic activity we're experiencing, it wouldn't take much to really knock this into a much worse outcome than we're currently forecasting here. But let's look at some of the details. If you turn to the next slide, please, you'll see the much talked about V-shaped recovery. You've all read about this, we all hear about it, but here it is very graphically. Now, these are our forecasts for this year and for next year. And you can see on the left-hand side of the chart, as I mentioned, growth was already slowing on a global basis. But of course, what we've seen in 2020 is truly profound. And that leads us to expect the bottom of this V on a global basis to be getting on towards a 3% contraction. Now, the good news, if you like, if you look at the right-hand side of the chart, you will see the right-hand part of the V. And indeed, you can see that growth for 2021, we suspect will be quite a high level by any kind of historic standards, in excess of 4%. Now, when you look at this slide, you think, well, actually, that doesn't really look too bad. What's the problem? You've seen a contraction and then you've seen an expansion. But a couple of things to point out. Firstly, to get a global contraction is extremely unusual. If you think about global demographics, the world is getting more populous, there are more people. So to get growth being stagnant is unusual, but to get growth to be declining, actually shrinking on a global basis, is extremely unusual. So that's something that's worth remembering. Now, if you turn to the next slide, you'll see that not only did I mention is this quite a profound event, but when you think about what we've lost or what we're giving up because of this recession, it's significant. This chart shows you two simple things. The red line, which has been rebased, is simply what growth was like prior to this year and what we had expected it to be going forward. Remember, I said we expected a mild recession. That's that little kink in the line in 2020. If you think about what the investments banks were saying at the start of this year, Goldman Sachs and others, they were actually expecting this red line to be picking up, accelerating much more. Now, what we've actually seen, of course, is something very different. You can see that the blue line shows you that chart I showed in the first slide, which is our expectations for growth in 2020 and then 21 and the impact that has. And as you can see, there's a rail track, a tram line. The gap between the blue line and that red line is what we've lost. This will not be recovered again. And to put that in perspective, in terms of thinking about it, that represents about the size of the Indian economy. This is a huge amount of output that has been lost because these economies have been unable to grow. Frank, did you have a question on that? No? Okay, if we move to the next slide, you can see here what we're showing you here is something called the Purchasing Managers Indicator. And this is a survey that goes out to companies every month. And this is looking at the service side of the equation. And it asks companies how they see their businesses. And it's a diffusion index, meaning that anything that's above 50 implies that these companies are seeing expansion. Anything below 50, not surprisingly, is that they see a contraction. And you can see really for the last few years, this line has been bubbling along and above the 50 level. Not surprisingly, we've seen growth coming through. But again, what you can see here is something quite dramatic. These numbers just collapse as we got into the April-May time period. And to put this in context, you can see that in the case of France, for example, picking on you, Frank, given that you're based in France just now, you can see this number got down pretty much to 10. And to put that in context, if you think back to the financial crisis and how bad that was in 2008, these numbers really only got down to about the 40 level. So this is profoundly worse than anything that we saw back in 2008. Now, of course, the good news is that there has been a recovery. You can see the pickup, the latest data shows that there has been a bounce in this. But again, to put that in context, this bounce, this level that we're at now, which again is still showing contraction going forward, we're not even back at the level of the lows of 2008. So again, remember that V shape I showed, it looked quite benign, but actually the impact this is having in the world is quite significant indeed. Now, maybe turning to the next slide, to put that in context, I mean, what do numbers really mean? And these kind of charts don't really give you the human impact. So what I've shown you here, and I've turned to the United States as an example, this is looking at the unemployment rate, the red line, and the blue line is a much watched monthly change in non-farm payrolls that you read a lot about. And I've not gone back to 2008 here, I've gone back to 1940, in other words, around about the Second World War. And this kind of puts in context what we've been experiencing from a human perspective. So you can see the red line unemployment rate. We've had previous crises, previous shocks in the past. But what we saw actually last month was that the unemployment rate in the US got up to 14.7%. But arguably more importantly, look at the payroll numbers. In the month of April, the US lost 20.5 million jobs. I mean, 20.5 million. If you think about that in the context of a US labor force, it's about 160 million. That's really, truly profound. And if you look at the workers that maybe not only have lost their jobs, but if you look at other workers who are having their hourly work constrained for economic reasons, not through choice, but because the economy and the companies are slowing down, that represents something like 1/4 of the total US workforce that have been impacted. So again, the charts look good, but the human impact is profound. Now, the good news on this one is that you can see actually the very latest readings that came out last week shows you much of a surprise to most economists and to the market. In the US last month, they actually added 2.5 million jobs. Again, that number in context of the history going back to the Second World War is vastly outsized compared to anything that we've seen. And indeed, the unemployment rate ticked down a little bit as well. Now, of course, this is also a function of the programs that are being put in place to encourage companies to bring back workers in order to benefit from some of the grants and stimulus that they're going to receive. Now, if we turn to the next slide, which is my last slide before handing over to Hokan, again, the important point of here is this is just looking at the fiscal stimulus in the United States, representing about 13% of US GDP. In other words, it's vast. And you can see actually some of the areas that this money is being put to work, not only large companies, but also small companies, households, other forms of businesses. Go back to what I said earlier. The point of this is to try and allow these companies to remain functioning so that when things look a bit better, they're then able to rehire workers and bring that back on again. And again, when we look at the very latest data coming out of the US and Europe, even yesterday, we're seeing encouraging signs. For example, US retail sales in the month of May was up 18%. That's a record jump that we've seen. If you look at home builder confidence in the United States, this is important because it has a multiplier effect, the housing market and the rest of the economy. That's now back above its long-term average. So there's some really encouraging signs coming out of this major part of the world's biggest economy. But now I turn to Hokan because, as I said at the beginning, we've often used the developments in Asia as a blueprint for what to expect in Europe and the United States. And I think that's going to be important going forward.
Hokan, if you can bear with me for a minute, I just want to raise a couple of questions first to Guy,
Sure.
if you're okay with this. Guy, going back to the last slide that you just presented, most of let's say economies in the world and governments initiated, triggered, I would say, schemes in order to support either, let's say, the unemployment impact, but and as a consequence also deploying measures to support businesses. So there is a kind of feedback from markets and economies that stating that basically we are going to see a surge of bankruptcies and business being stopped. We think around October, November, after I would say the government measures are going to stop or are going to diminish in terms of impact and magnitude. How do you see this this thing? Are we supposed to brace for impact in terms of seeing a very deep impact in businesses later on this year?
Yeah, I think that's a good point, and I think Hokan will touch a little bit on this in terms of what we're seeing in the more advanced parts of the world. But that is a risk. I mean, I think two things. One is, when you look at the scale of the stimulus that's being provided, both at the fiscal and the monetary level, there is a clear desire to make sure that these economies can stay functioning. There is an understanding that if they don't provide this amount of stimulus, then you will have not a recession, but potentially a depression that will last for many, many years. And therefore, I'm encouraged by the fact that you're seeing this. And again, if you look at an economy like Germany, they've in the past been very reluctant to provide any kind of fiscal stimulus, have been very fiscally prudent. But even in an economy like Germany, you're seeing they've got rid of their debt brake, at least temporarily, because there is an understanding that they have to keep things running. So to your point, I don't think they'll allow the stimulus to end abruptly, because again, that will be very disruptive. And I also think, much as we look at some of the manufacturing indicators that are looking good, I think it is true to say that the service parts of these economies, the parts that involves human interaction, you think about restaurants and will they ever be full again to the extent that they were, cinemas, all of these places. I think services are such the biggest part of the economy that I think these are going to take longer to recover. So I think there's a risk that this is not clearly an extrapolation of that VI mentioned, but I don't think they'll allow this to be a cliff either.
Thank you, Guy, and over to you, Hokan.
Okay, so if we can move to the next slide, please, because I want to show something on China. You know, China was the first in and first out of this crisis, and this shows when it was in. So this shows the GDP growth since 1992. That's when China started to publish quarterly numbers. And then look at the right-hand side, this incredible drop in growth. This is something I could have never imagined in my career, that I would see any quarter of negative growth in China. The worst that I could have imagined is something like maybe 3.5 plus or something like that. But actually, we have never seen something below even 6%. And then we saw this huge drop. One thing is positive in that these numbers are being published and not hidden. That's positive. But it was down 6.8% year on year, or if you look at it on a sequential quarterly basis, annualize it, it was nearly down 10%. So 10% drop in annualized quarterly GDP in China. Quite a significant drop, and everything contributed. And that was, as I said, first in, first out. That was something that then happened in the rest of the world as well, as you know, but then mainly in Q2. So if we can move to the next slide, please. That shows you the PMIs. Guy has been referring to these purchasing manager indices, and these are the samples that we have for China. So one is the official one, the NBS, that is more tilted towards the state-owned companies. And then we have the Caixin PMIs that are more tilted towards the private, smaller enterprises. Well, not small, but medium-sized enterprises. But the message here is that I want to show you that all of these PMIs in May back above this boom and bust line of 50, so showing there's growth again. We have to be a bit careful with these diffusion indices, particularly in times of crisis and in volatile periods like now. So you should not, they do not tell you that everything is back to normal as it was before. But it is very encouraging in that even the Caixin Services PMI moved higher. So it's both manufacturing, particularly also construction, and even services that have been inching back. Going to the next slide, I want to illustrate some of the monthly indicators that we are seeing. So this shows you industrial production, the blue bar. These are growth numbers, fixed asset investment, and then the red one is retail sales. And the first section is for January, February. Why have we taken this together? Because it's Chinese New Year. They do not tend to publish monthly numbers, but take them together due to these distortions. So this was what happened in January, February. Huge drop, particularly February here contributing, because January things were still okay. And then February, we saw the trough. That was the months when we saw the worst outcome in China. And since then, it has recovered. March, April, May. The May numbers just came out on Monday. And you see that industrial production growth is back at 4.5%. Investment is back. This is mainly driven by infrastructure spending. So that's something you all remember, the big events, the National People's Congress, when policy has been decided going forward. And this was a big point, so that there will be a fiscal impulse driven by infrastructure spending. And with infrastructure spending, I mean this is both the new segments like 5G, Internet of Things, electric vehicles and these things, but it's also, one should not forget this, it's also the traditional stuff, building airports, roads and railways. So this is also picking up. Retail sales improving, yes, but not back to normal levels. And this is mainly due to the services component. I think in the region, you see it everywhere. It's mainly, as Guy alluded to, it's mainly cinemas, restaurants, and so that are suffering. Domestic travel as well. International travel is nearly not possible. So these are the components that are dragging down retail sales. But for example, online sales in China now make up a fourth of the whole retail sales, and they have been up even 25%. So quite an amazing number, and things are getting back to normal in some segments, like for example, car sales. Car sales have been rising nicely recently, property sales as well. These have been problematic segments that are recovering nicely. With the next chart, this is another illustration on how things have recovered. We use some proxy indicators because we cannot always wait for the monthly numbers and the quarterly numbers and GDP growth, for example, to see what's going on. And we look at, in this case, traffic congestion, which is kind of a proxy of economic activity. And you see how that had suffered after after Chinese New Year, which coincided with the lockdown. So the blue line shows you the average of the prior 3 years. And of course, you see a blip. This is not due to any crisis. This is purely because of Chinese New Year, when everybody is traveling home, and the economy usually sees this big drop. So that is the normal pattern. But what we have seen this time, and because COVID coincided with Chinese New Year, as you know, that the drop was steeper, but the recovery was much slower. You see how traffic congestion has been quite severe and slowly improved, and now we are roughly back to normal levels again. With that, just to the next chart, please. Going to Japan. This is showing the business sentiment. We just got these numbers from a survey that people usually are not looking at. But for me, this is a leading indicator for the more famous Tankan report that you may know, you may have heard about that one, and that one will be released in 2 weeks' time. You can see what will probably happen with the Tankan, and that is a steep drop in business sentiment in the second quarter. And the blue line shows the large companies. The red one shows, sorry, the blue one shows the small companies. The red one shows the big companies. And the small ones are even below the levels that we had seen back in the great financial crisis. And they are suffering more, and sentiment has definitely deteriorated more significantly, which also has an impact on capital investment plans, for example. They have also come back, which has been a bit disappointing. Let's move to the next chart to show you the other side of the economy, the private sector, and you see how consumers have been suffering. The blue line is the so-called Eco Watcher survey. This is kind of also a diffusion index again, left-hand scale, where when it's below 50, clearly shows a contraction. You see how it has tumbled, and the last blip upwards is an improvement. We see that things are bottoming out as around the globe. We see things probably have troughed, are improving, but it's still at a very low level. And the red line depicts department store sales in Japan. And you see that even in the prior crisis, the great financial crisis, they have not suffered that severely. But now, a steep drop of nearly 77%. When department store sales dropped. Well, of course, part of that is because they had to shut down. Only the food departments were open, but already, even when they were open, we saw that sales had dropped significantly, as Japanese also were working from home, even though they have not been forced to do it, but they did it voluntarily as the government was asking them to do so. And also one impact is, and I think all of you participants in Singapore, you will see the same impact of the missing mainland Chinese tourists, because they have been also contributing significantly to the growth in Japan's department store sales. They have not been there, and they also have contributed negatively. And I think that's what you see everywhere. Macau, the casinos are empty. Hong Kong retail sales have suffered from that, and Singapore as well, as you know. So just going to the next slide around the region, kind of the pattern is really similar around the world, in that we see that consumer sentiment has been tumbling like a stone, but is recovering now after the lockdown. That's the important part. There is some more confidence. It has, of course, not recovered back to the previous level. And you see retail sales numbers. These numbers are lagging a bit for statistics, but usually they are following consumer sentiment. So we expect also to see better numbers on that side from retail sales. They will start to pick up again, even though growth will probably still be negative on a year-on-year basis. And yes, this is the thing that we are seeing in many other countries. Let's move to the next section, please. I have just two charts combining the ASEAN countries, so I will not show any detailed countries. And here, again, kind of the same story. You see the PMIs that we have referred to for the manufacturing side, the red line, that they have been tumbling as well, but are also starting to recover. You see the new export orders subcomponent of this PMI for the ASEAN countries. This is an important one, and to us it's a leading indicator. It has deteriorated significantly, but also started to recover recently, still at a low level below 50. And let me just mention one thing, because I'm not showing it. India, the Indian PMI has been tumbling to a level of only 2. So imagine I mean, it cannot be more than 0, and 2 is something I've never seen, and I will probably never see again a level of 2. That was the impact that the lockdown in India had on the economy. And as you know, despite increasing infections, they just had to open up. They had to close to stop the lockdown, and are opening up again. And with that, we probably will see an improvement in these terrible PMIs as well. The blue line shows you the growth of the major 4 ASEAN countries, Malaysia, Indonesia, Thailand, and Philippines. And we do not have the numbers, but you can imagine that along the lines that the PMIs are showing us, GDP will recover, but will still be negatively affected overall. And with that, maybe to the next slide, please. Fiscal stimulus, that's a topic around the world. Guy has referred to it. It is one of the 2 big pushes that are contributing to this V-shaped recovery, monetary policy on the one side, and the fiscal stimulus, and we see that nearly everywhere. And this just shows you the numbers for the ASEAN countries. We have to distinguish, because you are reading about all these nice headlines, 20%, 15% stimulus package has been announced. These are usually the headline numbers. So these brown levels here, light brown levels, showing you the total size of the packages. But the pure water effect, what we say in Japan, for example, the direct fiscal stimulus and spending that is giving a boost to GDP growth on the spending side, that is shown by these red or salmon colored bars within this bar chart. And you also see the deficit estimates have been rising significantly. They have been deficits, of course, even before the crisis, marked by the little cross. But you also see how deficits are rising, and this is unavoidable. This is the only thing you can do. Guy mentioned Germany. Yes, Germany has never been tilted to fiscal spending. Has always argued that they have to be prudent, and now they are spending big style. And this is the same that you see across the world, with a few exceptions. For example, Vietnam is doing this to a less extent because the economy has been doing better than other ASEAN countries. And then finally, to the last slide, coming from Asia. This is then of course the consequence that debt will rise. But you can see that the debt to GDP ratio in percent, the dark blue line shows before the crisis, and now after the crisis for 2020, of course, debt will rise. You see the left-hand bar for developing countries, quite a significant increase to 120% of GDP. Emerging markets, less so. There are some countries in the emerging markets that are worrying, but this is not the case for most of the Asian nations, because the debt levels are still quite okay. And you see the big one here, Singapore, is a bit distorting because this actually shows gross debt, but on a net debt basis, Singapore has no problems at all. So don't be terrified by this big bar here. And you see overall, yes, debt is rising, but it is sustainable for the Asian countries. And with that, I want to hand back to Franck, yes, who's raising his hand.
Maybe, yes, I have a few questions for both of you, but I'm going to start with you, Hokan, in terms of the very last slide that you just mentioned. Should we consider large economies in Europe, USA, and economies in across Asia to be closer to the public debt to GDP ratio that we are entertaining in Japan over the last 15 years? I mean, are we going to see a new norm in terms of this public debt to GDP ratio around the 150 to 200%? How do you see
No, I
that
think
evolve?
no, I don't think so. I think that is far away. You also have to remember that most of the Asian countries are dependent on foreign capital. This is not the case in Japan. In Japan, the debt is actually only to a rather small share dependent on foreign capital. It's only about 7%. Most of it is financed domestically. So with that, Japan can afford to have much higher debt to GDP numbers than most of the other countries, and particularly many of the ASEAN countries, for example, Indonesia, are dependent on foreign capital. So they cannot afford to have these high debt levels. However, it is unavoidable they will increase, and you see that, but they is still at a still a rather healthy level. Maybe Guy, if you want to add something on that point.
Briefly, I think it's I think one thing to kind of sum up what you've seen in all these economic slides is that the global debt will be rising, whether it's the household, whether it's the corporate side, whether it's the government side, it's going up, not down. I remember my very opening comments was it was already at record levels when we started this crisis, and we're going to end this crisis with even higher levels. So completely agree with everything that Hokan has said. That noted that we are seeing in the case of Europe, debt levels are getting to the stage where people are questioning the sustainability. We think, for example, Italy will move from about 135% debt to GDP to 160, again, very different to the levels we know in Japan. But we're getting to the point where these economies, these countries, they need interest rates to remain at very depressed levels in order to carry that debt. It's a vulnerability that there is, but it also leads us to our view why we think that global interest rates will remain incredibly low for an incredibly long time. Because if you think about it, were rates to go up much, then the carry cost of that debt becomes a real problem. We would then tend to see more defaults in the corporate space, and at the government level, it just becomes more of a challenge to fund that. So one of the reasons why the legacy of this will be higher debt levels and lower interest rates, we think, for some time.
Okay, thank you, Guy. Maybe, Hokan, a couple of follow-up questions regarding Asia specifically. One of them is coming from Devesh out of Mumbai. He's mentioning the fact that if you look at past pandemic instances, they were followed by a kind of depression cycle. And so do you expect a similar outcome as an after effect of during the next coming years? I mean, how do you see this? I mean, obviously, I know that you don't have a crystal ball, but how do you see this evolving?
Actually, I don't see the risk of a depression unless there is a second wave that is even bigger than the first wave, which is not our core case. Why? Because of just what Guy has alluded to, this huge spending spree that we are seeing around the world from the governments and monetary policy. So you see what the Fed has been doing, and many of the other central banks have been supportive, and that is the reason why there is no depression. Remember that the big depression was also caused as there were not these kind of countermeasures taken by the governments and the central banks, and this makes me quite comfortable in that I do not see a risk of a depression. There will be severe recessions, or they are already in many countries, and they will be bigger in some that are even more affected. But to call it a depression is a bit far-fetched.
Okay, thank you very much. A follow-up question on this, I would say, this recession situation we are in, especially for Asia. We saw a few governments, and for instance, Japan, issuing a stimulus to I would say, incentivize corporations to retrieve their industrial activities from China back to back to Japan. So we know that going through this recession and recovering is all about also making sure that globalization will sustain or will come back. How do you see this type of government reactions going to evolve across the region? Are you I would say foreseeing more I would say protectionism being financed by governments for corporations?
Well, I think there will be certainly more protectionism, and we will probably not come back to the same level of globalization that we have seen before, which is, I think, less a topic for Japan, but mainly due to the conflict between the US and China that will have an impact. You see the initiatives, particularly from the US, President Trump even asking big corporations to withdraw from business in China and coming back to the US, which I think is will not be followed by the major ones. Where we have seen a shift back already before the COVID crisis has been in the case of Taiwan, where Taiwanese companies have brought business back to Taiwan. And that actually has boosted growth in Taiwan. Taiwan is doing relatively better than many other countries. This is not only because they have been more successful in tackling COVID, but also due to the fact that some economic activity has been coming back to Taiwan, which is particularly important in the semicon business. But overall, my opinion is that there will be more protectionism, but it will not be that substantial that global growth will suffer tremendously. Probably trend growth will be lower than without this tendency back from globalization. But we will still see enough growth once the situation will stabilize.
Thank you, Hokan. And to Guy and to you, obviously, I know that there is still a few slides to cover. So I would suggest that we go through them, and then I will ask you, I will ask both of you the remaining question I have on my list, if it's okay for you, guys.
That's fine, Frank. So maybe if we turn to changing pace a little bit, let's turn to markets, because you've heard the pretty grim impact from an economic perspective. Yet, when you think about it, we're in a global pandemic. You've seen the numbers in terms of economic growth, really depressionary, not recessionary, in terms of the Q1 and Q2 numbers that we're seeing. We don't have a vaccine for the containment of the virus, and indeed we've got unemployment affecting 1 in 4 US workers. So when you put that in context and you would ask somebody, where do you think financial markets are likely to be? I don't think people would say that the NASDAQ US kind of tech exposed index would be up 10% year to date. So what's going on? So let's look at a couple of slides, starting with this one, which is still on the negative side. So here we are, corporate earnings. Now, this is analyst expectations for the S&P 500 as an example, and you can see that up until relatively recently they were still pretty optimistic. They tend to be a bit slow, frankly, to factor in real world, but you can see that finally now earnings expectations in the US have plunged 30-35%. We're seeing even more in the case of Europe and the UK. Earnings expectations are down between 40 and 50%. So this is clearly a reflection of what you've heard from Hokan and myself in terms of the economics. I mean, clearly from a profitability and revenue, you depend on consumption. Now, what that's doing, of course, is that you also saw with some of our slides the stimulus that is being applied. Governments are concerned about giving stimulus out, and they're making certain demands on companies who receive that. But also companies themselves have been actually quite quick to suspend dividends or cut dividends. If you look at a company like Shell, cutting dividends for the first time since the Second World War. That kind of puts in perspective how some companies, some well-known multinational companies are being impacted by what we're seeing here. Particularly in the US, the dividend repurchase, sorry, the stock repurchases, which have been a major contributor to the market moves over the last number of years, a lot of these are now being suspended as well. So this economic element is having a real impact in terms of corporate profitability and what they do in terms of returning earnings to shareholders in the form of capital and dividends. The next slide shows you however, in part answers that question I posed about why are markets doing so well. This is looking at the Fed's balance sheet. And just quickly on this, we spoke about the fiscal stimulus that governments are applying. But of course, central banks have either cut interest rates to the lower bound. They don't really want to go into negative territory. They've looked at what's happened in Europe by having negative interest rates here in Switzerland, minus 75 basis points. There are unintended consequences of that. So, of course, what they've been doing is really the only thing that they can do, which is scoop up assets, creating asset price reflation. And this chart shows you the size of the Fed's own balance sheet. Again, you can look at what's happening in Japan, you can look at what's happening in Europe, but just from a Fed, for example, you can see that we're now getting close to $8 trillion. Trillion, you keep having to make sure you're not writing billion, but these are vast numbers. And to put that in perspective, look at the little pickup you can just see back in 2008. Remember when quantitative easing came on the scene for the first time? Remember there was outrage that the central bank was buying assets, getting in the way of market forces. What were they going to do? How were they going to unwind that? Well, you can see, I mean, that's now a little blip in relation to where we've got to over the last 10 years, but also just in the last month or so, you can see we've had this big pickup from 4 to 8 trillion. And that's only going to go one way. That's going a lot higher. You can see the further commitments that we've got. And this is the chart that I would say answers that question. How come, given this macro backdrop, how come, given this health crisis that we're in, how come, given a global depressionary environment, markets are up? That's the reason. The reason is that when you look at global central banks, the actual money committed purely to asset repurchases, we're talking in the region of $6 trillion. That's a huge support to the market. Now, turning to my last slide, you can see putting this in pictures what's been so significant. So you go back to the bursting of the dot-com bubble, you can remember that. You know, the S&P 500 fell by 50%, and it took some time to fall, and then you can see it took some time to recover. Now that was just basically a recession caused by a sector of the market that was burst. You go to 2008, the great financial crisis, and you can see that the S&P 500, given the balance sheet recession, the subprime loan problem that were going on, the S&P fell by 57%. Again, relatively protracted, and then look how long it took to get back up again to that level. Now look what's happened. Look what's happened in the last 2 to 3 months. So we had all of the issues that we've just been speaking about, and peak to trough, and remember the markets peaked in February. From peak to trough, we only had a 34% decline. It was the sharpest 30% decline in global markets. The US fell by 34%. But look what's happened subsequently. We've had a rally of more than 40%. As I said, the NASDAQ is actually up year to date, getting close to all-time highs. And that really tells you that these central banks have succeeded. They've succeeded in preventing a health crisis that became an economic crisis, becoming a financial market crisis. 2 crises you can argue maybe you can just about cope with, but a third one, a financial crisis, and you remember what happened in 2008, they did everything they could to prevent that happening. And one has to commend them because they did put a floor under this. They did see these markets only falling by 30-odd%, and they have required or provided the stimulus in order to create asset price reflation and to create a wealth effect, hopefully coming through again. But the problem that we have now, of course, is that the extension of these markets is now diverged so much from the underlying economy. Multiples are so high. Remember the chart I showed you about earnings? Multiples are so high compared to the underlying fundamentals that there is a risk that this market is being driven purely right now by liquidity. And while that we think will continue maybe for a bit longer, you need these economies to play catch up to give a real fundamental story in order to make this rally a more lasting affair. So to conclude, maybe Frank, that last slide, and then we can take any more questions that you have. The last slide just sums up what we've been saying, which is clearly a sharp, very deep recession, but it is following that picture of a V. We are expecting a big recovery. Don't forget, however, and don't underestimate the lasting impact, the scar tissue that the global economy will have. The size of India, just picture India being given up in terms of economic output every year. The fiscal stimulus, the monetary stimulus, this has forced central banks and it's forced politicians and governments, even Germany, who's reluctant to provide the fiscal. It gives you an idea of how significant this is. Europe finally beginning to embrace the concept even of mutualization of debt and a recovery fund. All of that's important, but don't forget that we will be left. You know, if we're having this conversation in a year's time and our base case is right and things are looking better and we've got through this, in a year's time, debt levels will be higher, not lower. Governments, households and corporates will have more leverage and have more dependency on low rates for a longer time than they've had. And lastly, one thing I will say is that whatever we've said today, Hokan and myself, it's all questionable because it's all dependent on an unpredictable virus. How will it morph? How will it mutate? Will there be a vaccine? Won't there be a vaccine? Will infection rates pick up? In our base case, we always assumed there would be a second wave. But of course, if this gets out of hand again, you know, we will not be talking about a deep recession that recovers. We'll be talking about a much darker place that is much more resembling the 1930s, despite the stimulus being provided than what we've put down here. So I don't want to end it on a negative note because certainly things are looking better. But I will say, Frank, that the problem we've got, unlike typical exogenous shocks or national or natural disasters, there's no endpoint to this, like a volcanic eruption or a tsunami. This one is very hard to predict where it's going to go, and therefore it's hard to model the impact.
Guy and Hokan, thank you very much for this presentation. I have a few questions, and we still have about 6-7 minutes to go. So the first one is coming from Isaac. And Isaac is asking you the question, Guy, regarding your Fed, the Fed balance sheet slide that you presented. And his question relates to the fact that as the Fed is accepting riskier and riskier assets into its balance sheet, do you think that eventually it will cause a collapse like the one we had for the last global financial crisis?
The answer is no, I don't. But it is a profound shift. The first time they've ever taken on credit risk. Not only are they taking on credit risk, but they're prepared to buy fallen angels. In other words, companies that have fallen from investment grade to junk status. And the size of that balance sheet is a challenge. But one thing I will say is that, and Hokan touched on this in Japan, when you have countries that have their own currency, their own central bank, they have the luxury of being able to afford some of these large positions because they can simply print money. Now, we're usually worried about that, of course, because it's inflationary. But when you have inflation expectations falling and when you have the deflationary forces coming into play, then it's less likely. Look at a country, small economy like Switzerland, where, of course, the central bank has taken on explicit exposure, not just to credit, but to equities, and not just domestic equities, but international equities, very large, certainly big in terms of the size of the country. It's a risk and it leads to a dependency, but in answer to Isaac's question, I don't think it's going to be a problem in the near to medium term, certainly.
Okay, thank you, Guy. Next question relates back to you were alluding to that your scenario is basically taking into account the evolution of the disease itself. From what we can tell today, we know since Monday that in China they are seeing a surge of infections, especially in the Beijing, the capital city area, and they are starting now to reconfining quarters of the city, etc. If and I don't even know if it's a question of if. I mean, working for International SOS, we have the our medical experts telling us that in history, each and every pandemics gathered a couple of additional waves to this, and obviously the extent of it relates back to our ability to find vaccines or to find a cure to it. To which extent you are seeing you remain, I would say, cautiously optimistic about the recession we are entering in terms of this potential evolution of the disease itself. I mean, having one or two additional waves.
Maybe Hokan will comment on China specifically, but more broadly, yes, we did think. I mean, looking at other pandemics, it would be second waves. But I guess two things in our base case. One was we didn't think that there would be a second lockdown from economic perspectives. I mean, we've seen also countries like Sweden try different models, the US trying a different thing as well. And we also felt that would differ from many of the developed world economies to the emerging world economies, because of course there's an unintended consequence of all the other problems it creates when you lock down. You know, we see it certainly in Europe with cancer patients and cancer wards, but of course just survivability, making sure you've got food to eat is a problem. So broadly speaking, yes, we did think it was going to pick up. If we have to have something that really is a lockdown, as I said, that's a dreadful outcome. Also, I think what's different about this pandemic perhaps is the resources that's being devoted on a global basis to finding a vaccine. You know, I'm still skeptical about how long it's going to take, but certainly there's some signs that there may well be, because of the money, because of the research, that we may get something rather than the 4 or 5 years that typically it takes. But it's certainly a risk, and it's the biggest uncertainty we have in our base case. But Hokan, do you want to say anything specifically about China?
Yes, of course, it's eye-catching that this broke out again, particularly in the capital in Beijing. But I think China has learned its lesson and is taking the right measures, very drastic and immediate measures to contain this. I think we have now 138 new infections, active infections, 250 for a country with 1.4 billion. That's nothing. So here I'm less concerned. Even though it is eye-catching. Where we are more concerned is like is that it's in some parts of the US, it's increasing in Texas, Florida, California, Arizona, and so on, but also in countries like India, Bangladesh, Pakistan, where they, for economical reasons, just to survive, had to open up the economies again, even though infections are still increasing. And that is well true for many Latin American countries as well. South Africa, and so on. So these are the regions where I have bigger concerns than China.
Okay, thank you very much, Hokan. I mean, it's almost time to close this session. So here again, I would like to respect the Swiss habit of starting and ending up on time. So I'm going to do that too. I would like first a couple of things I would like to share with the attendees today. First of all, a very sincere thank to Hokan and Guy for the great job you did today at sharing this very insightful substance to all of us. I'm pretty sure it's helping a lot all our members and all the participants to the call in terms of having a better understanding of the economic evolution for the months to come. So very, very sincere thanks for this. I would like obviously to thank as well people who have participated to this session. Obviously, the world is complex, and we were talking about the economic outlook and evolution related to COVID-19, and I'm pretty sure that Hokan and Guy, next time we can talk about other things which are happening in the world, such as major elections going from which are going to happen in a few leading countries, the evolution of the US-China trade war, and obviously the ongoing oil and gas crisis and the geopolitical uncertainties attached to it. So there is still, I mean, for risk managers attending the call, it's all about looking at the holistic way of things, and there is a few other, I would say, underlying trends that needs to be considered when you look at all of this. Thank you very much again. The next Parima webinar is going to happen on Monday next week, and it's going to be on risk financing and the solutions that the insurance market can provide to businesses to go through this to go through this crisis. This will be done with another partner of Parima, namely AXA XL. But today, I just want to end the call by thanking very sincerely Guy and Hokan and Zurich for the support and for the very appreciated substance. I can see a few very appreciative comments coming from the floor. So guys, it has been appreciated. Thank you very much. Stay all safe and well, and talk to you very soon.
Thank you all.
Have a good day.
Bye-bye. Thanks.